following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp, brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, and welcome back to Options Bootcamp, the show where we bring in you, the raw options recruit, and then we break you down and rebuild you into seasoned options veterans. My name is Mark Longo from the optionsinsider.com, as well as the ever-expanding, ever-popular, ever-entertaining and informative Options Insider Radio Network, upon which I'm sure many of you are listening to this fine program right now. And of course, I'm not alone on the old Options Bootcamp drill instructor squad. No, not by a long shot. I'm joined by two fabulous drill instructors in their own right, starting off with the options specialist, nay, the major domo, over there at Sogo Trade, none other than Mr. John Critchley himself. John, welcome back to the program, sir. I hope you have your hat and your whistle ready to go.
I'm just so honored to finally be bestowed upon that the title of Major Domo. That's really, I'm just tickled. I mean,
you've been waiting for quite a while, I know. You finally earned it. Yeah. And we couldn't give it to you in the first couple of shows. You had to earn it over time. And I think it's fair to say that you have earned it now.
I appreciate that, and it should be a great show.
And I'm also joined by the Viceroy, perhaps even the Archduke, over there at Market Taker Mentoring.
I like Archduke. Viceroy sounds a little sinister, Mark.
Yeah, it does sound a little sinister, you know, but you have a little bit of a sinister air about you, sir. I don't know if anyone's ever told you that before. A wee bit of menace. That, of course, is Dan Passarelli from Market Taker Mentoring. Dan, welcome back to the show to you as well.
Well, Mark, it is really wonderful to be back in action here at Options Bootcamp.
You know, our listeners have come to expect some quality sound effects from you, sir, so we'll have to perhaps cut in a few for you, perhaps send you over a nice whistle for a future show so you could do their eardrums some damage before the show even begins.
All I want for Christmas is...
There you go. That will be in your stocking. We will see to it. All right, listeners, and with our drill instructor squad assembled and our whistles at the ready, we're going to dive into our basic training segment.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Pull in, prepare to learn. Yes, sir.
All right, and welcome to the basic training segment. This is, of course, where we walk you, the listener, through some basic options concepts and explain to you what they are and why you might want to utilize them in your own trading. And you may remember on last week's episode, we did a review of spreads, why they're interesting, why you as a trader may want to utilize them yourself. And this week we're going to take that and expand it to the next level. There's a myriad of different spread options out there, pun intended, for you to choose from when considering which spreads to add to your portfolio. And of course, when you're choosing amongst these different spreads, there are a variety to choose from. And we've seen a lot of people over the past couple of years in particular really gravitating towards one class of spreads, I suppose you can call them. And for our purposes here on the show today, we're going to call those spreads with wings. I can't take credit for that. That was John over at Sogo Trade who came up with that little moniker. And so we're going to focus on some of these very popular spread types like butterflies and indeed condors, and also their counterparts, the iron versions, the iron butterflies and the iron condors. And no, we're not talking about some quality music from the 70s, but indeed some interesting options spread strategy. So that's going to be our focus for today, these spreads with wings. And it's taking the concepts we learned last week of that simple vertical, the simple collar type trade, and just expanding upon them a little bit. We're going from the simple two-legged spread. Remember, the legs of the trade are the two different contracts, essentially. So you're in a simple vertical two-legged spread. You're buying one call or buying one strike. You're selling another strike, buying one option, selling another option. Now we're expanding upon that, going into three- and four-legged types of spreads. So it's a little bit more complex, a little bit more advanced, but also they can be far more useful in a variety of different scenarios. And so I think the spread with wings that most traders come to first after they cut their teeth on the basic vertical call spread and put spread as they start thinking of ways to perhaps combine those ideas and do something along those lines. And that's when they first really stumble across the butterfly spread. Now, Dan, I know you're just a degenerate butterfly trader from way back. You love the fly. Can't get enough of them. I'm always telling you, Dan, do you really need to trade a fly here as well? And you always tell me yes, because you're just Mr. Hardcore butterfly trader. So why don't you walk our listeners, first off, what is a butterfly, and then some of the pros and cons of a position like that?
Well, a butterfly, simply, the best way to look at it is it's a combination between a debit spread and a credit spread. There are three legs to a butterfly. For a call butterfly, a trader would simply buy a call, let's say the January 50 calls, sell two calls with the next consecutive strike, so maybe sell two January 55 calls, and then buy one call with the next consecutive strike, so say the January 60 calls. So it's a three-legged spread, 1 by 2 by 1. And a trader would execute such a trade if he thinks the stock will be trading at a specific price, which would be the middle strike, around the expiration date of the position.
You're right. It is a simple progression from the simple vertical, which is just a straightforward two-legged spread. Now we're talking about that that three-legged spread, the butterfly, which is indeed the 1 by 2 by 1. It has a lot of different scenarios. And, in the scenario you outlined where you're selling the guts or the middle part of that butterfly, you really are thinking about a scenario where you have a stock. Perhaps you're going into earnings. Volatility is very inflated. The at-the-money strike is where you position those two short call strikes, and you think that volatility, A, is inflated, it's going to come in, and B, you don't expect a significant amount of movement in the underlying. You expect vol to just come off after that earnings, a type of event or event like that. So that's a scenario where you might want to employ a short butterfly like that. The reverse of that would be the 1 by 2 by 1 where you're buying, of course, the two and selling the two ones or selling the two wings of that spread. And that would be the opposite scenario. That would be a scenario perhaps where you have a stock where you're not sure, or a stock where you think the volatility is low and perhaps is due for some inflation, or perhaps it is due for a bit of a move, and you want to position accordingly. The butterfly gives you a little bit of utility on that side as well. John, are you a big proponent of the butterfly? Are you I know some guys really love them. Some guys can kind of take them or leave them. I'm somewhat in between the two camps, and I'll explain why in a minute. But I want to get your opinion on this first.
You know what I really love doing butterflies, and when I've written about this in the past, I'll go back and I'll use a program like, I'll look back at Apple earnings, for example, or Amazon earnings, and I'll look over a 2-year period, and I'll say the average move has been about 8%, and now the at the money straddle is trading about 8 or 9%, and that's a lot of premium. If you buy the straddle and you're wrong, you're really going to take a bath. And if you buy it and you're right, it goes 8, 9%, kind of break even. But I like to sometimes, just in a speculative play, to do butterflies, buy one, sell two, buy one. If Apple's 600, I'm going to take up maybe, let's say 10% to 660s and calls, and then down to 540, maybe I'll do a put butterfly. And you can put it on for sometimes very low amounts. You can put it on for 25, 30, 35 cents. And if you're right, it goes to $5. Now, normally that's very low probability, but it might go, if you're right, it could go to $1 or $2. And again, it's a speculative play. You're going to be wrong more than you can be right. But every so often you can hit a triple. And I like to use them every so often.
That's a good little analogy there. I think successful options traders, we see a lot of retail coming in for the first time, swinging for the fences, whereas the successful options traders utilize spreads, and they tend to aim for singles and perhaps doubles. And that's where usually the better long-term payout scenario and profitability lies in that scenario versus the load up on some garbage out of the money calls or puts and swing for the fences, and either you hit a home run or you blow out. And I think we all know on the show where we tend to come down on that type of debate. Now, I mentioned earlier, I kind of fall in between the two spectrums of very pro and somewhat indifferent to butterflies. And I think before I just explain why, I'm going to rope in a listener question we have, and I'm going to pull that from the mail call segment because it's actually very relevant to what we're talking about here, so it doesn't make sense to wait for it. We have an email from Alan Rick, and he writes, what makes a spread, quote, iron? What is the difference between an iron butterfly and a regular butterfly, iron condor, etc.? Thanks, and please keep up the show. I'm learning a ton. And the reason I read that now is because when I say I'm somewhat in between, I am, because I'm not a typical call or put butterfly guy. I tend to fall down more of the iron variety, the iron persuasion. The iron butterfly is indeed one of my favorite trading strategies. I utilize it all the time, both for my own trading and when I'm talking to a lot of new retail customers coming into options. I typically find, even though the name is scary and it's an extra leg involved, I think the iron fly tends to be a little bit more intuitive for a lot of new retail traders when they're coming to options. So, Dan just walked you through the typical butterfly scenario where it's a 3-legged spread. You're buying one in the money call, typically selling two, perhaps at the money calls, and then buying the one out of the money calls. It's the 1 by 2 by 1 type of scenario. The iron butterfly is similar, but it's expanded upon a little bit. So instead of the call in the money and out of the money spreads, or call spreads, or put spreads if you're doing a put fly, we have essentially an in the money put spread and an at the money put spread and an at the money call spread that you're typically trading with an iron fly. You can do it out of the money too, but typically this is the way it's structured. So instead of doing the one in the money call and then one at the money call like you would in the typical fly, you are instead doing, in this case of the iron fly, if you were buying and selling, it would be buying an out of the money put and then selling an at the money put. So you're essentially selling an at the money put spread, and then you turn that to the other side here on the iron fly, and you're selling and one at the money call and buying one out of the money call. So you're actually combining an at the money call spread with an at the money put spread. Or you can also look at it as a straddle with two protective wings in case the worst comes to pass and the stock really moves in a significant direction. And the reason why I say this is a little bit more intuitive is because people can think of it in a couple of different ways. They can think of it as a straddle with the wings as a protective buffer. They could think of it as a call spread with a put spread. And that usually lets people wrap their heads around this type of strategy a little bit easier. And that's one of the reasons why I say I prefer the iron fly versus the regular fly, even though it is a little bit more complex, has an extra leg involved. And also because it tends to fit with my trading strategy very well. I like to trade in and around earnings quite a bit, and in scenarios like this, again, you might think earnings are inflated. Going into a scenario like this, you could sell the iron fly picnic, the at the money strike right there at the front month where the earnings are trading. You think the underlying is going to come off from a volatility perspective, but not perhaps move substantially from a underlying movement perspective, from a delta perspective, then this type of trade would be ideal. This is the trade I utilize quite a bit in my own trading strategies, and indeed also when I'm walking newcomers to this options business through the concept of butterflies. Dan, are you an iron butterfly guy as well? You tend to stick to the more, I hate to call them plain vanilla, but that's kind of what they are, plain vanilla call flies and put flies.
No, I prefer the iron myself, Mark. And
I knew we gelled. I knew the two of us were simpatico for that reason. I think, just great minds,
Well, I like the iron basically for two reasons. One, Mark, is essentially the reason that you just said. They are more intuitive, and you can look at them a couple of different ways. Like you said, it's a short straddle with a long strangle for protection. Of course, the other way to look at that is two credit spreads. And that's very intuitive, very simple. The other reason I tend to like them more is that you're pretty much using all out-of-the-money options if you're doing an at-the-money iron butterfly. Perhaps one of those options might be slightly in the money, but mostly out of the money. And the thing I like about that is that out-of-money options tend to have tighter bid-ask spreads. So when you trade them, you're giving up less to the market.
An interesting point as well, sir. And, we always like to counsel our listeners to take different strategies and different types of approaches to different scenarios. A lot of people come to us looking to trade earnings, and we always tend to hesitate to recommend to them selling a straddle, for example, or buying a straddle, even worse, usually going into earnings. But this type of approach where you have an iron fly allows you to do something like that, but still have a risk mitigated approach, whether it's premium mitigating the risk on the long side because you're getting a few rights to offset some of the expense you have, or on the case of if you're selling straddles, you can then also have the wings to mitigate your outliers and mitigate the full amount of risk. So if the worst does come to pass and after earnings the stock implodes, you have a finite amount of risk that you're facing. So we always tend to prefer approaches like this to someone coming in and just, let's say, blasting out a straddle during earnings, or just blasting out a call or something like that. There's definitely better ways to do these types of things, and this would be one of them. Now,
can I just add?
Sure.
Can I just add one thing here? For a professional trader, and you guys made an excellent point. Why the long iron butterfly spread is a pretty neat little spread is for the retail customer. It's a little easier to understand. One by one by one by one. But for a pro, the long iron butterfly spread, the butterfly spread, yeah, as you guys well know, traders hedge everything. They're exactly the same. But for the retail customer, this might be actually easy to understand. That's why they're pretty nifty little spread.
Yeah, of course, when you start getting into synthetic territory, all of these spreads tend to shake out the same, particularly when you're talking about regular flies and call flies versus put flies being the same thing. But it's interesting nonetheless to get into some of these dynamics, particularly when we're talking about a show like this, when we're getting into the explanation side of the fence and getting people to wrap their heads around these concepts for the first time. The iron fly, even though it sounds scarier, is sometimes the easier point of entry for a lot of people. Now, the other spread with wings that has just taken off, to abuse that metaphor to a great degree, over the past couple of years, I would say, is the condor. And, of course, its variation, the iron condor. But we'll start off with the basic condor first. I can't tell you how many newsletters and how many different guru services and educational services I've seen out there over the past couple of years popping up, expounding and extolling the virtues of condors, particularly iron condors. And that just seems to be the trade du jour these days. So Dan, why don't you walk us first through the basic condor, and we'll look at that a little bit, then we'll get into the iron variety.
Sure, Mark. I'll shortcut it a little bit, and instead of going through all four options that are involved in this leg and trying to force our listeners to visualize this in their head, let's just say it's a butterfly with one extra strike in there. Instead of being 1 by 2 by 1, it's 1 long by 1 short by another short by a long. So much like I originally described the butterfly as a debit spread with a credit spread, it's the same thing here. It's just that there's no shared
strike. There's not one single middle strike. There's two middle strikes. So, for example, long the 50 calls, short the 55 calls, short the 60 calls, long the 65 calls. And mainly, generally speaking, how a typical non-professional trader trades those is as an income trade, trying to trade a directionally neutral market. The trader generally wants the stock to close between the two short strike prices around the expiration date.
That's a good way to think of it, is just the butterfly perhaps expanded a little bit, and instead of having that one at-the-money strike, you get a little space between, and now you have essentially two middle strikes as opposed to one at-the-money strike, and they're usually two separate strikes. Now, the condor is one thing, but I think the spread that has just fascinated millions, particularly in the retail side, is the iron condor. If there's one trade, one strategy over the past, since we launched Options Insider, coming up on 6 years now, which is crazy to think of in and of itself. But if there's one strategy that seems to have just gained traction with the masses, unlike any other, it is certainly the iron condor, particularly writing iron condors. That seems to be just where the action is at these days. So Dan, how do we break down the addition of the iron condor? How does the iron condor compare to the plain vanilla condor, if you will?
It's exactly the same parallel that we described with the iron butterfly versus the butterfly. Here, instead of having that in-the-money debit spread component, we do, well, effectively the synthetic, which I believe John pointed out earlier. We sell an out-of-the-money puts credit spread, and we sell an out-of-the-money call credit spread. The objective is for both credit spreads to remain out of the money by the time expiration rolls around, and both of those premiums collected to represent the maximum profit potential that can be made.
Yeah, and this really comes down to a bit of a religious divide, a schism, if you will, in the options world, as whether you come down more on the iron fly side of the fence or the iron condor side of the fence. As you outlined, the iron condor gives you a little bit perhaps higher probability but a little bit lower return, because you're, instead of having those two options on the at-the-money strike, which are going to be meatier and juicier both from a premium perspective and from a Greek's delta, vega, gamma, theta, that sort of thing, you're going to migrate that a little bit away from the at-the-money to a little bit out-of-the-money strike. So they're going to be a little bit higher probability of expiring worthless. So if you're riding them, that makes these very attractive, but also you're not collecting as much for doing that. So I tend to fall on the iron fly side of the fence, a little bit easier to execute. You don't have that extra layer in between. You're getting a little bit more bang for your buck by doing this, but you're right, that is a little bit more management involved sometimes in the iron fly, because you're right at that at-the-money strike. Any sort of vacillations in the underlying, whether it's going around expiration or going around earnings, could entail some headaches for you. The iron fly gives you a little bit more cushion, so you have a little bit more, you can sleep a little bit easier at night. I think that's probably why that strategy seems to have taken off to a greater degree than the iron fly. Would you agree with that, Dan and or John?
I mean, one thing I'll say about the iron condor, it is extremely effective trade when implied volatility becomes elevated. Like, for example, right now, because of the movement in Apple over the last month or so, the 30-day implied volatility is about, I think it's over 30%, which is very high. And so along iron condor might be a good play here. I think I looked at today, and I think if you went down 10% out to April and up 10% out to April, I think you could collect like $2 or $3 or $4. So, yeah, I mean, that's when these become more attractive, when the implied volatility goes higher. If you're trading a low implied volatility, if you're trading G or some low implied volatility stock, these trades aren't there's not enough juice. These trades are great when there's a lot of premium involved and high volatility, and that's that. And your risk, again, if you did the Apple trade, your risk is you have a 10% window on your side. Anywhere in between, you're going to be okay. So they're good when the volatility starts to become escalated.
Of course, you're talking about from the selling perspective, where that's really where that's where the high volatility becomes attractive. If you're buying iron condors, where you're buying that close to at-the-money strikes, you want to tend to avoid the high vol scenario, usually, and there are scenarios where that's not the case, but that's typically where you want to execute. And that's, of course, where we see the bulk of the iron condor trading seems to come in on the short side of the equation. People use these as a very risk mitigated, defined risk type of trade, as opposed to, like we said, just coming in and blasting out a straddle or blasting out individual options. This gives them a much better, much more controlled way to write these types of, or trade these types of scenarios. And like I said, the iron condor, particularly writing the iron condor, is extremely popular. I'm sure you, listener, have encountered this if you've been interested in options for any period of time. You've heard about the iron condors, you've seen the services out there. You can, of course, go to sites like the Options Insider, search for iron condor, find out all about these types of things. There are a lot of other services out there that would do this as well for you. And the one thing I would counsel all of our listeners to do is that there is so much hype around this particular strategy right now. This is one of the reasons why I wanted to bring this up on the show today. And it just seems to be almost, and there's so many newsletters out there promoting this strategy, selling their services to recommend iron condors for writing. Sometimes they're the auto trade services where they execute for you. There's almost a cottage industry has built up around writing iron condors. And what we've seen of late is actually, in this type of environment where in a lot of scenarios, Apple being obviously a clear exception, volatility is becoming very elevated in there. And a lot of other names, volatility has come off substantially. So this is certainly, I hate to see traders come in and develop the one tool for their toolbox. And I talked last show about the collar being the kind of the one trade to rule them all. I was doing that somewhat tongue-in-cheek because I prefer to have traders have multiple tools in their toolbox for different scenarios. The same applies for the iron condor. You don't want to have to force these trades. That's where we're seeing a lot of people coming in now. They learn about iron condors. They've worked for them a bit in the past when volatility was a lot more elevated. Now we're getting into a period where it's a little bit difficult, particularly right now as we're recording this. We're getting into the tail end of 2012, into December, and we're looking at things like the fiscal cliff looming on the horizon. There's a potential for a lot of uncertainty, potential for a lot of volatility, potential for a lot of underlying movement in the market over the coming weeks and months. And so if you're out there forcing a iron condor sale in an environment that is not suitable and is not highly desirable, then you end up getting on the wrong side of that risk-reward equation that we talk about on the show a lot. So if you're out there and you're an iron condor writer, you're thinking about becoming one, this trading strategy appeals to you, I would just caution to you to not always be forced, or not look to force these types of trades, because that's one of the mistakes we see quite a bit. We've talked about big options mistakes, frequent options mistakes on this show in the past. This is one we didn't get to, but I thought about including it even on this show. It's a very specific one, but forcing the sale of iron condors is one we've seen time and again. If you like this strategy, it works for you, that's great. But it doesn't have to apply in all scenarios, and indeed it doesn't apply in all scenarios. And if you're a premium writer, maybe you want to flip that coin every now and then. There are times you might want to buy an iron condor. It works the other way as well. There are times when things are cheap and it gives you a lot of bang for your buck as well. So we like to see our listeners become more nuanced traders and just the type of guy who has one strategy in his toolbox and he uses that time and again, whether or not the scenario really justifies it. So Dan and John, that's our summary here of the two most popular spreads with wings, as you will. Anything else you guys would like to add on the condor or the iron condor or the butterfly or the iron fly before we close out our basic training for this episode?
You know, the only thing that I would add is just sort of a little bit of closure, I guess. It's really important that if you're going to trade these spreads, that you know that you know what you're doing, and spending the hour with us learning something about these trades is a great start, but make sure you really understand and make sure that you're able to sit down with a pen and a piece of paper and draw out the risk diagrams yourself, and maybe even have a little bit of an understanding of the Greeks of these things, so that you don't end up getting caught off guard. Because once you start getting 3 or 4 legs to a strategy, they can start getting a lot more complicated than just a simple 1-leg or 2-legged strategy.
The one thing that I wanted to add was that I know I keep going back to this and touching on this, but when you enter these spreads, just be careful about entering market orders. I know I keep repeating this, but you know when you're dealing with one leg, or now 2 legs, now 4 legs, you're going to have a spread and again, if you go market order, you may pay $1.50 where mid-market is 50 cents. So just be careful with that. And another thing I wanted to touch on real quickly is this idea that about scanners and how scanners can identify butterfly opportunities, or a lot of times vertical opportunities too. And I'm not a big fan of scanners, and I want to warn some of the customers just to be careful about off-the-shelf scanners, because a lot of times what they'll do is they'll pick out a strike that has an outlier bid, a 1 or 2 cent bid, and then they'll pair that off with something maybe more at the money, and they'll say, wow, look at this. You can buy this vertical spread, for example, for 2 cents. That might go to 250. Well, that's really unrealistic. It's the same as buying really far out of the money call. So just be careful when you're looking at any kind of spreads in a scanner to just take that with a slight grain of salt.
Hopefully, John, by this point, if they've listened to all 13 or 14 episodes of this show, that they've learned at the very least not to work market orders in options anymore. They should at least have the level of sophistication to work their limits. And that should be, if you learn nothing else from the show, hopefully you took that away, listeners.
We actually had a case internally that it was discussed, although not pretty seriously, about banning market orders for options, because we had a customer that went in on a pretty liquid option market order to sell a put, pre-market, like at 9.25, and the put was $5 in the money and got executed for 1 cent, and we weren't able to bust the trade because the exchange rules are you're not entitled to the BBO, pre-market, because it will get routed. I think it got routed to the ISE, and I think I'm going to say it was Citadel that did the trade, and the customer wasn't entitled to like a 480 print everywhere else. That's why I know I keep going back, and I know I'm a broken record on this, but just be careful. We couldn't get the trade busted. No, we ate the trade. We made the customer whole, but just be careful, because sometimes you may not get the great fills with the market orders.
That's both a cautionary tale and a bit of an inspirational one. It's cautionary that's an atrocious fill. That should really, the executing exchange or the executing market making firm really should have stepped up on that one, because that's not an enviable scenario for anyone. The market making firm doesn't benefit from that either. Obviously, they get the near-term value of having scammed that customer out of nearly $5 worth of premium, but of course they're going to lose a customer forever. That doesn't help anybody. But I'm glad to see also they got a bad fill, but I'm glad to see a firm like yours stepped up to make them whole, John, because that's exactly what you want to hear in that scenario. It's a painful thing to have to do, but customers, that's a great example how if you're trading options, A, watch out for the market orders, and B, you want to go to a broker like Sogo, who, if something like that happens, they've got your back. That's a literal example of a brokerage firm having your back in that scenario. If they'll make you whole on a trade that's worth almost $5 in your face, that's an impressive thing. So I think that's something worth noting. And listeners, if you're an options trader or thinking about becoming one, that may be something you want to weigh in your brokerage decision down the road. But for now, I think we're going to close out this basic training segment on spreads with wings. I hope we gave you a nice little walkthrough of the iron condors and the flies and the iron flies, so that you can make some more informed decisions about which you'd like to add to your trading arsenal down the road. But now we're going to roll on into our mail call segment and give you, the listener, a chance to join the show.
Mail call. Time to look at questions submitted by our listeners.
All right, and welcome to the mail call. This is indeed where you, the listener, get your chance to join us here on the Bootcamp Drill Instructor Squad and have your voices be heard. And we're going to start off with a very appropriate question here from Alan Charter. He asks, if I think a stock's volatility is elevated going into earnings, should I write an iron condor or an iron butterfly? Which is the better trade? Now, obviously, I just touched upon this in the basic training segment where I discussed where I come down, on which side of the fence I come down on, I should say. That is, of course, I tend to prefer the iron fly for these scenarios. I'm not averse to the iron condor. I just tend to prefer the iron fly for the reasons I just hit upon in the last segment. John and or Dan, maybe Dan, we'll start with you. Which do you tend to prefer? Obviously, it's kind of a bit of a scenario-specific one. Not every trade tends to fit every scenario, like I just mentioned as well. But I tend to lean more iron fly than I do iron condor on average. Do you lean one way or the other?
I tend, if I'm going to choose between those two strategies, I tend to lean iron condor because I just kind of like that wiggle room.
You like the cushion?
Yeah.
So you're saying you're a little baby who can't hang with the at the money side. That's what you're saying, huh?
That's exactly right. You saw right through me. But, I feel I'd be somewhat irresponsible not to just point out that if you're looking at high implied volatility right before earnings, you better be pretty darn careful using either of those two strategies because they're both negative gamma strategies. And if the underlying stock makes a big move on earnings, like it often can, you can run into a lot of trouble real quick.
Yeah, and that's always been, the downside we've seen flies. A lot of these people who have been writing iron condors over the past couple of years, they, like I said, tend to force them in scenarios where perhaps it isn't ideal, including a lot of earnings scenarios. We've seen a lot of people get very hurt. Netflix being a big example last year. That took off. Hurt a lot of people at Chipotle earlier this year. Obviously, if you're doing iron flies versus something like just writing naked out of the money puts, you're going to do a lot better because your risk is limited there versus the out of the money put guy who's just going to blow out. And certainly we saw a lot of people over the past year blowing out in trades like Netflix that dropped almost 200-300 handles, and Chipotle dropped several hundred handles as well post earnings. So these things can certainly happen out there, and if you're going to choose one strategy or the other, we certainly would prefer you choose a nice risk limited strategy like the iron condor or like the iron fly, so that you could at least have some degree of protection on that type of trade versus just what a lot of people also like to do, just blasting out those downside puts that we've talked about in the show in the past, and can certainly be a dangerous trade. Sean, do you tend to lean one way or the other, or are you kind of a either or type of guy?
I actually lean towards the iron condor also.
We got two little babies on the show with me today.
and the reason why I say is that because I actually am a long premium buyer by nature. So the iron condor, if I had to pick between either one, I prefer to pick. I mean, to me it's like you're of course you're selling a put spread, selling a call spread. You're selling, and stock can't go both ways. It's gonna go one way. And if you price it right, and I do advise the clients, or I tell people when I write about it to try to go back maybe 4 or 5 quarters and look how the underlying has moved, let's say, on earnings, and also look at the at-the-money rattle, and that will give you a pretty good indication of what the market expectations. And these market makers are very, very smart. I mean, they have this price usually pretty spot on, and it's a very hard job. So they're going to give you an indication of where they think or where the market's saying the underlying is going to move. And if you can put your iron condor around those frameworks, I think you're going to be okay most of the time. Now you're going to have an event like the Netflix and Chipotle and other ones, but for the majority of them, they're going to be within that range where you make money. So I think I prefer the iron condor.
And of course, listeners, I'm teasing. They are not indeed babies for choosing the iron condor. I'm just giving them a little bit of a hard time. But yes, it certainly makes sense if you're a premium buyer. The iron condor is a much reduced outlay in that sense. So it certainly is usually more attractive on that front than the iron fly. And John, that's the second or third time you brought up here on the show that you tend to lean towards the premium buying side of the fence. I find that very interesting because so many former market makers and professional options traders, and indeed a lot of active retail traders as well, tend to lean towards the dark side, as I like to call it, the premium selling side of the fence. So that makes you relatively unique in and of itself. And also the fact that you said, I think, in the past, which also has surprised me, that a lot of these SOGO customers are premium buyers as well, which I think to me is just a fascinating development. You guys over at SOGO seem to have really cornered the market on the long premium side of the retail equation. So well done. My hat is off to you, sir.
Maybe it's my influence. I don't know. But
yeah, you must be luring them in somehow.
I mean, I was just, I happened to be trained in a specialist book that, dealt with a lot of takeovers, Pillsbury, E.F. Hutton, and the like. So they had a proclivity for being long premium, and I was just raise that way. And when I first started trading, within 6 months of a year, I was in that Lotus story that I won't mention again, but I mentioned in an earlier podcast. So when those scenarios hit you, it becomes ingrained in your body, and I just never wanted to be carried out one day, losing all the money that I worked so hard for. So that's just my personality. However, I will say that the premium sellers do very well also, and I know a lot of premium sellers made a lot of money and are still in business. So, pick your poison.
I'll have to bring you on one of our other shows, Volatility Views, John. You can meet one of our other hosts, Don Schlesinger, who is a diehard premium seller. He says options should be bought or not bought. That's his mantra. So perhaps I'll bring you on that show, and the two of you can have a nice discussion about the merits of buying premium and the intricacies therein. But that is indeed for another show. All right, and next up in the mail call segment, we have a tweet from Mr. Dockerson. I like that. And he writes, Apple, 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 all with exclamation points. What are your favorite Apple spreads right now? This is, of course, the other $1 million question. We had the $1 million question on the last show about what's the best spread. This is the other side of that coin. Everyone wants to know. Apple, how do you trade? Apple, we touched on it earlier. Apple is in this interesting scenario. It seems to have shifted a bit as an underlying. In the past, it was very much a single trajectory to the upside, rallying from 200 to 300 all the way up to nearly 700. In the wake of the post-700 era, let's say, it's become a much more volatile stock. It's trended to the downside as much, if not more often, than to the upside. Of course, as we know in the equity markets, whenever we see downside, that typically equates to volatility. Apple, as we're recording this right now, is trading around 530. It's got down as low as close to 500 in the past. So it's been a very volatile name, and in many ways it's a different name than it was even a few months back, when it was kind of a more sedate type of name. You can count on that steady upward trajectory. You might have some vol around earnings, but that was usually the extent of it. It wasn't this highly vacillating type of name. You could count the number of days that Apple had severe down days on probably on one hand going back the last couple of years until we hit that 700 point, like I said. So the strategies that worked on Apple a few months ago are now the ones that work now are very different. And as John said, it is an elevated volatility type of scenario. So if you play your cards right and take advantage of spreads that take advantage, or utilize spreads, I should say, that take advantage of those types of scenarios, you can do fairly well. I think the one thing a lot of us, pretty much all of us on here in the panel, would not recommend is that you come out and just start blasting out downside puts or even upside calls at this point in Apple. It is, like I said, a very highly volatile stock. That may be a tempting thing to do because the premium levels are so high, but this is a very volatile name, a very expensive name as well. You can easily find yourself with a severe margin call if you look at the name as whipsawed 20-30 handles, and suddenly you have a substantial Apple position that you've inherited at a price that is not entirely desirable, and you're getting a nice call from your broker saying we need some more money from you. So you want to avoid that at all costs. I think all of us would recommend the nice spreads and risk mitigated type spreads. Ironically, we talked about Apple a lot on our network. I haven't really traded Apple much at all over the past couple of years until recently. And it's gotten in this more volatile environment, it's become more attractive to me. And I've been legging into a lot of interesting put spreads and things like that. I love risk reversals. I haven't utilized them as much in Apple just because I haven't seen a good setup that really intrigued me on that end. But an interesting one, if you're a long equity holder, I think the collar is still indeed very attractive. The puts are more expensive right now because volatility is elevated. You can offset that with that covered call element. Apple also, remember, Apple is a unique, is almost a unique name, I should say, in the equity space because, as John touched on skew earlier, the upside call skew in Apple is a unique phenomenon, almost to this name. It's more reminiscent of a commodity type of volatility skew than it is an equity. Typically in an equity name, you'll see the volatility trailing off rapidly in the upside call wing to the point where the volatility is essentially moot and non-existent in some of the upper out of the money strikes. Apple, you have almost a different scenario where we joke about them a lot on these network shows, the Apple zealots, what have you. A lot of people out there still believe in the upside of Apple, and they will continue to bid up these calls, and they bid up the volatility levels to extremely high levels in Apple. So you have a inflated upside call wing that is also ripe for a lot of interesting strategies. So maybe Dan, we'll start with you. What are some of your favorite spreads right now, or favorite trades in Apple right now that take advantage of some of these scenarios I just mentioned?
The thing is, when implied volatility is elevated, like you see to the upside in Apple, that promotes an opportunity to get in there and sell options, put on some negative Vega plays, because, the fact of the matter is, if the market ever comes around and wakes up and says, why the heck are we buying all these upside Apple calls, bidding it up? This is not, we're creating a pricing discrepancy, and they stop buying all those upside calls, implied volatility will fall, and you can make money on Vega. Now, probably that's not going to happen anytime soon, because like you pointed out, Mark, there's Apple zealots out there. They're just crazy for this stuff. So the other rationale for selling the high implied volatility is when you sell implied volatility that's too high, that means the options are too high. They're overpriced. And when options are too expensive, that means the theta that a short option trader is getting is more than that trader should be getting. You're getting bonus theta, if you will. And therefore, because you'd just be trading the spread, whether it be a call credit spread or some sort of iron condor or that kind of thing, if you're putting on that trade as just a pure theta trade, you're getting free theta, extra theta that theoretically you shouldn't be getting, because those options are just so darn overpriced. So that's what I refer to as edge, market taker edge, edge for the rest of us, edge for the non-professionals. That's how you get it, by looking for opportunities
edge
like
for the rest of us.
Created. yeah.
I like that.
Okay.
Two good terms, bonus theta and edge for the rest of us. But, I think that's precisely why I've seen a lot of people migrating their liquidity into the call wing there. We've seen people taking their butterflies, their iron condors, and instead of writing the at-the-money ones, moving them into the out-of-the-money call wing a bit, just to capitalize on that extra level of juice you're getting on the upside. So maybe they'll buy one at the money, then write two out of the money, then buy one more far out of the money, and trying to double down to get more bang for their buck by taking advantage of that upside skew. We also have seen people doing fairly well on ratios to the upside. That's a little bit more dangerous, obviously, because if Apple gaps up, you really, you could be in for a world of hurt. But if you know how to manage it well and set up your, ratios 1x2s, etc., to the upside, and you have a lot of cushion to the upside, that could be a profitable trade as well. And certainly in the earlier environment, that was a great way to go, because they kept this upside bid to a level that is just you don't see in a lot of other names. So a lot of interesting strategies you could do. I'm sure, John, you get this call probably 5 times a day. So what do you say when someone calls you up and say, hey, what do you think about Apple right here?
Well, there's a few things. I'm hopeful in a future episode we can do the stock repair strategy. But because there's such retail investment in the Apple underlying, there's been a lot of customers that probably bought Apple from $700 to $525. So that would be an excellent strategy, especially when you have the elevated out-of-the-money calls to do what Dan has suggested in past episodes, to do a stock repair strategy. But, 2 other things here. When I see the out-of-the-money calls trading at, again, I mentioned this earlier, at a equal to or greater than volatility than the lower strike calls, that's a green light for me. And you only see that usually in takeover again, in biotech stocks, and on some of these tech stocks like Apple, that people just are true believers are going to buy the out-of-the-money calls. So that's a green light trade for me, doing some long verticals here. The stock has been so beaten up that any good news, the stock could really bounce. So you can get in pretty cheaply, even though volatility is high. I'm talking about a spread aspect. You can get it pretty cheaply doing some long verticals. Now, if you're a premium seller, volatility is very elevated here. So we go back to the condor trade. You can go out 10%. And I think I looked earlier, if you did 10% selling downside put spread, upside call spread, I think it was for like $3.50 going out a few months. So maybe that's a trade also. But for me, I green light the long vertical when the out of the money calls become very much bid.
Yes, that's a a great simple scenario to follow. It may sound counterintuitive, listeners, to buy premium when volatility is indeed bid, but like we said, the upside calls are unique in Apple. They retain a level of volatility that other names don't, so it allows you to leg into verticals when you're selling that upside part of the call skew to obviously the upside part is also inflated. So you're buying one that's inflated, you're selling one that may even perhaps be more inflated. So it allows you to leg into these spreads at a dramatically reduced premium level, which is of course attractive for any spread buyer. And I also will hit again, I touched on collars earlier. If you're an Apple underlying holder, and I'm sure a lot of you out there are, and you're not trading collars, you're really missing out, because this is a unique name that's very well suited to collars. The puts are inflated, so they're somewhat expensive, but as we mentioned, the upside call wing is inflated and is inflated across a variety of scenarios. It perhaps is not as inflated right now as it has been in the past couple of months, but it still holds a lot of value in that upside call wing from a volatility perspective. So if you're not buying protection to lock in your gains and also taking advantage of that inflated nature of those calls to offset some or perhaps even all of the cost of that protection, then you're really missing out. If you're trading Apple underlying, you should be collaring it right now. It's just a advantageous scenario to take advantage of. So there you have it, Mr. Dockerson. Hope we walked you through some scenarios. I don't know which side of the fence you fall on, if you're a premium seller or a premium buyer, but either way, you have some ideas in there. If you're perhaps even an underlying holder, there's some ideas for you there as well. So different ways to trade Apple, all of them pretty interesting, all of them pretty unique. Apple, a unique name everyone wants to know more about. Maybe we'll hit on some more Apple in some upcoming shows. But right now, that's going to do it for our mail call segment. That's also going to do it, unfortunately, for this episode of Options Bootcamp. But before we go, I like to check in with both of my cohorts here on the Options Bootcamp Drill Instructor Squad to see what they have going on in their respective necks of the woods that may interest you, the listener. Starting off with you, Dan, Mr. Viceroy over at Market Taker Mentoring. What is coming up in the land of Market Taker Mentoring that may interest our listeners?
Well, Mark, on my website, I don't know if any of you are aware of this, but I have a free weekly newsletter. It's called the Options Blog Newsletter. And you can go to my site and you can sign up for the Options Blog newsletter for free. It doesn't cost you anything. You get some great education. You get some market information. You have a calendar of events on there. And it's a really, really great resource for you. So please check out markettaker.com and you can sign up for my free newsletter there.
There you go. Take advantage of all the free info you can get, particularly when it comes from guys like Dan, who know the business and who won't steer you wrong. So there you go, markettakermentoring.com. And of course, the folks over at Sogo Trade, we talked earlier about how they ate a nearly $5 loser for one of their customers. That's the level of customer service you can expect from guys like John and the folks over there at Sogo. So John, what else can our listeners expect and look forward to in the coming weeks and months over there at SogoTrade.com?
One thing we have, Mark, and I've been working on is that we have a strategy section, a specific strategy section on our website that I wrote all the material for. I've revamped that a little bit. We're going to add some more strategies, and customers should really go there, and it gives you a nice P&L chart, risk reward, the tactic, and all that stuff. So we're going to revise that. We're having hopefully a new platform or a new website being released in maybe the next month or two, we hope, and it's going to have a lot more education on it, a lot more links. We're going to have a blog on that. So we have a lot of exciting things coming in the new year.
Well, great. We'll look forward to those there at SogoTrade.com, listeners. And if you haven't checked them out, I encourage you to surf over there, check out SogoTrade.com, see what they have to offer. You can, of course, listen to episodes of this show right on the homepage there. So a lot of fun stuff you can do over there at SogoTrade.com. Check it out. I think you'll like what you find. All right. And, of course, if you'd like to learn more about any of the topics we discussed on the show today, as well as any of the archived episodes of this program or any of the other programs we have on the Options Insider Radio Network, then by all means surf on over to theoptionsinsider.com. You can find all the episodes of this program as well as learn more about all the topics we discuss on this show and much more. Check it out. I think you're going to like what you find. And of course, on behalf of all of us here on the Options Bootcamp Drill Instructor Squad, Dan the Viceroy, John the Major Domo, and myself. Perhaps I'll be the Archduke today. We want to thank you all for downloading and streaming and subscribing to this program and making it such a success. And we'll see you next time right here on Options Bootcamp.
Options Bootcamp is brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.